Hello, folks. I am Crystal Parker, Financial Education and Community Outreach Ambassador for the Credit Union, and it's great to be with you today. As you know, we're talking about raising financially responsible young people. The path to raising financially responsible young people might feel like an uphill battle where we're pushing this stubborn rock, but that's really not the case. Hopefully, raising financially responsible young people is more like giving them a hand or giving them a little push, but they're going to do the work and we're going to give them some coaching and encouragement along the way. And hopefully soar off into adulthood. Here's what we're going to cover this evening: the magic of saving, the 5 W's of giving an allowance, establishing credit, preparing for life after high school, how we can help young people soar. Well, let's dig in. But before we get into all of the details, let's talk about one important fact. Being a financial educator, I like to look into the research behind financial education and why it matters. And in 2018, the PISA report was released from the Organization for Economic Cooperation and Development. This looked at a variety of things, but one of those things in that report talks about financial literacy. And one of the things that they found is that students who succeed financially have 2 things. They have an account with which to learn with. They need to be banked, or as I prefer to say, credit unioned. So having that is important, but they also need financial education. The 2 are great, but they really go hand in hand because students need that practice with which to learn and practice what they're doing. So the 2 things are really important. So it's really important to start students of all ages with a savings account. And I always encourage, make opening an account a special event. How many of you can remember when you got your first account? How old were you when you got that account? Who took you to get that account? Do you still have that account today? For many of us, that brings back some really fond memories, and perhaps it brings back fond memories for all of us. Opening your first account is a big deal. I love when I see young people coming in to open an account, and I know that I'm not the only credit union staff member that gets excited about this too. So let's dig into the magic of savings. The first thing we have to think about is teaching young people to save. It's crucial, especially when you look at the data that for many Americans, they do not have $500 in their savings account to cover an emergency, let alone 6 months of savings in the event of job loss or injury. So teaching the importance of saving is the first thing we have to teach young people. One of my favorite lessons to teach with high schoolers and sometimes middle schoolers is something called the game of choice. And in this, we go through all of the various life expenses that they might have. And students are regularly surprised that saving is an expense. We don't think of it that way, but it's an important one. We're paying ourselves. So the first thing we have to do is pay yourself first. It's also important to help young people to set a goal. Goal setting is really important. So on that piggy bank or save jar, perhaps they can put a picture or a dollar amount for which they're saving. The next thing when we're talking about savings with young people is to talk about sharing. Now, for most kids of all ages, when they hear the word share, they're thinking that we're just talking about sharing it among friends or family. But getting into charitable giving, whether it's financially or with our time and our talent, is an important thing for all of us. We as a credit union know the importance of giving back to our community, and it's important for students to start thinking about that. If your student in your life happens to be a second grader and has done the Sammy's Big Dream lesson with us, they would remember how Sammy is saving for a goal, but his friend was saving too, but didn't have enough money when it came time for paying for their special trip. But Sammy had done so well saving, he was able to share with his friends. So sometimes sharing is with our friends and family, but it's an important aspect of the savings and sharing and spending habit. This is a thing most young people want to do. We all want to spend, honestly, but thinking about our money in these three ways is teaching young people about budgeting. It's a little bit different for kids of all ages, whether in elementary, middle, or high school, than it might be for an adult. But this is a good benchmark and way to start with saving. You might notice on the screen some jars, and this is how I encourage young people to divvy up their money. They can use whatever jar they have in the house. They don't have to buy something special. They could make it or what have you, but labeling it save, share, and spend. And sometimes that spend jar might be a wallet if they're responsible with their money and able to keep up with it. But thinking about their money in these three ways is the magic of savings, because the first thing we have to do is to save. But this isn't all we need to teach them to do, right? They also have to learn about earning money. So let's have a poll. And I've got to give me one moment. I'm pulling it up for you. Do you or did you give your children an allowance? Now, I know for some folks, maybe you weren't financially able to do it, and that's okay. Great answers coming in. So it looks like we have a mix. Only some have given an allowance, some weren't able to do it, and many didn't. That's totally fine. Now, jumping ahead. So we'll talk more about an allowance in a moment, about whether or not you've given one, but this is an important question for all of us to have. I'm going to stop sharing our results. And now we can talk about the 5 W's of giving an allowance. So it sounds like not everyone here, the majority, did not or could not give an allowance. And that's okay, but let's talk about it anyway. Who needs an allowance? Kids do. Why do they need an allowance? This teaches them budgeting. And for so many folks, I don't think this is something they realize or often think about. But by having their own money with which to spend, this gives them the opportunity to learn to budget their own money. So there's a what to this. Is an allowance tied to doing chores? Do you just get an allowance? Do you have to do chores to get an allowance, or should you do them because you live in the same household as everybody? We'll dig into this question momentarily because I know there's lots of thoughts on this one. How much should you give in an allowance? And honestly, this is really a personal decision, but here's some things to think about. Make sure it's an amount that they can use. I'll use my own child as an example. When we first started giving her an allowance, we started really small. We started with 4 quarters. And the reason we did this was because she needed to divide her money between her 3 jars: save, share, spend. And having 4 quarters allowed her to have a quarter to go in her save jar, her share jar, and then she had 2 quarters with which to decide. Were they both going into her spend, or would she split that extra quarter up? But if you think about this, 4 quarters doesn't give her very much to spend with. Over the course of the month, she'd receive $2 that she typically had to spend, and that wasn't enough. So we eventually increased this to $1 per year. Now, with a younger sister getting an allowance and the older sister getting an allowance, they're each getting enough that they can put some into their save, their share, and then their wallets or their spend jars. And it gives them enough to be able to go and buy the things that they want. Not necessarily the things that they need, because I'll get those for them, but it gives them enough money to spend what they want. Now, as your kids get older, perhaps middle school and high school, and maybe upper elementary when they're going and doing things with friends, perhaps after the pandemic, but thinking about, do you want to give them enough allowance to cover what you would give them for going out with friends? If you're not going to pay for them to go to the movies every week, maybe keeping their allowance a little bit less than the cost of going to the movies. And teaching them that element of choice, that they can't spend all their allowance on one thing or at one place. Now, when should you give this? That's really going to depend on an individual basis. Each kid is mature enough to handle money at a different age and a different time. Some earlier than others, some later than others. But do they know how to recognize money? Do they understand the value of it? And you also have to think about, when during the month should you give them this allowance? Should they receive it weekly, bi-weekly, monthly? Some of this is to get them in the habit of how they will get paid when they're growing up and getting a job. Not every job pays every day. Most don't. Not every job pays every week. Some pay bi-weekly and some pay even monthly. So this gets them in that habit of learning to ration out that allowance they have throughout the month. Now it's time for another poll. Should an allowance be tied to doing chores? And you can answer this whether or not you gave your child an allowance. So it looks like we're pretty split on our feelings of this. And honestly, I think this is a family decision, whether or not you're going to make an allowance be tied to chores. The most important thing is teaching young people how to budget and balance the money that they have. So whether or not you want this to be tied to chores is up to you. Some families will not tie it to chores, but kids can earn additional money for doing extra things that are out of the norm. So it's a personal opinion. Now, the next thing we have to help young people with is establishing credit. And before we can help them with establishing credit, it's important for us to understand our credit score. We're not going to cover this in detail tonight because this is an entire class of its own, but I'll cover some basics. A credit score is a number that predicts your credit risk. It is constantly changing, and for many financial institutions that are looking at lending, they're typically using the FICO scoring system. Whether they're looking at Experian, Equifax, or TransUnion, they're based on the FICO scoring system. Each person has a unique credit score to them. Even though you may think you are using your money almost identical, each person's may look slightly different. And it's ever evolving. And I really like to think of credit scores as part of a pie. As you can see here on the screen, this pie is not evenly sliced. I might want to have a small piece of pie after eating a large dinner, but if I'm having pie for breakfast, I probably want the larger slice. And when it comes to our credit score, we probably want to look at the slices that are the largest. The first of which is our payment history, which is 35% of our credit score. The one thing I can recommend for folks is to make sure you pay your bills on time. There are bills that we have that are not tied to our credit score at all. But if we got into a situation where we were behind on that bill and it then got turned over to collections and there was a judgment tied to that bill, that can affect and will affect your credit score. So making sure to pay everything on time and to be in communication with your various lenders and creditors is really important. Now, the next piece of the pie that's worth the most is your amounts owed. And this is something I think folks forget about, because this is looking at those revolving credits we have and how much we have outstanding. So if you have multiple credit cards with different limits, but all told, your available credit is $10,000 that you could spend, you wouldn't want to max out all of your credit cards and lines of credit and then have this large amount that you're paying, because then you're seeing those impacts on your credit score. The general rule of thumb is to not carry a balance of more than 20 to 30% on a line of credit, particularly with those credit cards. But if you can pay it off every month, even better. Now, the other three pieces of the pie, we have the length of credit history. And for most young people, they're not going to have a long length of credit. And so that's something that's not going to help them. But there's also the new credit. You'll see that when someone applies for credit, there'll be a dip in their credit score, but that will increase as that payment history is showing positive. And the types of credit, variety is the spice of life. So having a variety of types of credit can help your credit score. Hope that's helpful information, and it's a good basis for young people. One of my favorite things to do with young people is to talk to them about credit, especially when they're in their junior and senior year. Seniors really start to think about this as they're preparing to graduate from high school and set off into adulthood. And we have a game that we love to play called Soar that we developed with some other credit unions. And this really helps students understand the various factors that affect their credit score. But when talking to young people about credit, think about, what have you learned? Share that knowledge with them. And then, are there things that you need to learn? Maybe talk to them about those things, and together you could do some research and learning. It's okay to admit we don't know everything. Frankly, most teenagers don't think we know anything at all. And it's also important to talk about, what mistakes have you made? I know that I made mistakes when I was first starting out with a credit card, not understanding what all I should do and shouldn't do. But when we make those mistakes, we hopefully learn from them and it prevents them from happening. So when we have the courage and the vulnerability to talk to young people about these things, it can help them down the road. So how do we help them establish credit? The first thing to do is to start with a checking account. We've talked about how they need to start with a savings account, and I think of banking, credit unioning as a kind of a progression. You start with savings, you build that savings habit, you're good at putting money away, and then you get to the part of having a checking account. It's really important for young people to have that checking account with some supervision at first to make sure that they're spending their money appropriately. They're not spending more than they have. They're learning how to check digital banking to see what they have in their account, and to know that they may have used their debit card and that transaction has not yet deducted out of their account. This is the thing that really trips and stumbles up a lot of people, especially young people, when it comes to their checking account. It's also important to get young people to start checking their credit report. For many of us, we don't think about young people needing to do this. And if we're completely honest, many of us aren't the best at checking this every year. But if we go to annualcreditreport.com, once every 12 months, we can get a free copy of our credit report. Now, this will not have your score. There is a fee associated with that, but checking your credit report allows you to see that all of the things in your credit history are true and factual about you and helps to prevent identity theft. Young people can be victims of identity theft, just like us adults. And it's important to build that habit of checking it every year. It's a good rule of thumb to do this during tax season because it's something you do every year. So having that as your benchmark can be really great and helpful. The other thing you can consider doing is making them an authorized user on your credit card. Now, this isn't something for everybody, but if you're comfortable, and it could be they don't have access to this credit card, but they're simply an authorized user on a card that is used regularly and paid off regularly can greatly help their credit score. And to also consider what happens when they get their first loan. If they're under 18, they probably can't be on the auto loan, but when they are of age and when they're eligible to start getting credit, they're not going to qualify for that first auto loan on their own, but they could be co-borrower with you. So those are some things to think about to help young people with establishing credit. Now, we also have to prepare them for life after high school. And it's important to start this conversation early. For so many young people, they're shocked to learn how expensive it is to go to that college of their dreams. And none of us want to be dream killers or crushers, but we do need to talk about the actual cost of going to school and to know what all of their options are. College is not for everybody. For many, trade school is a really great option. We will always need folks who are good with their hands that can go out and fix things. I am not someone who's going to fix my plumbing on my own. I need a plumber. I'm not sure I can be trusted to fix the electricity and to wire in some new lights. I need an electrician. We need those folks who are good with their hands and are in those technical fields that can go out and do things, and trade school can be a great option. Many of our school system also have great career CTE programs, careers in technical education, that they can get started before they even graduate. Another thing to consider is community college. This is a great way to save money on college. I'm not that old, but I'm also not that young. And it's been a while since I've been in school. And so the cost of college has gone up tremendously. The last time I looked, my alma mater has gone up 5 times what I paid per semester. It's frightening sometimes, the cost of college, but community college can be a great option. There are even dual enrollment opportunities. John Tyler Community College has options for some students that are in schools near them. And J. Sargent Reynolds has partnered with Henrico County Schools for their Advanced College Academy at Tucker High School and Highland Springs High School. So there's some options for students to get started on those college credits before they even graduate. But there's also the Transfer Gateway. And this is something for students to look into if they decide to go from high school to community college, because there's the opportunity for them to earn their associate's degree and have guaranteed admissions if they follow the right criteria to get into a variety of Virginia schools. So take a look at the Virginia Community College system and look at the list of schools, and then go to those school sites to learn what their transfer requirements are. Some have GPA requirements, but this can be a major cost savings. But for many students, college and four-year colleges and universities are a great option too. But it's important to talk about the difference between private schools, state schools, in-state and out-of-state. Those costs can be huge if you're looking at out-of-state options and private options. But that doesn't mean all will be cost prohibitive. There are some schools out there where it is actually cheaper to go to this private school out of state. So do your research, visit the schools, and find out what's a great fit. But make sure the cost of college is part of that conversation too. Lastly, don't forget about graduate school. Depending on what young people want to do, graduate school is part of the picture. So making sure that they're not taking the most debt when they're going to their college, where graduate school is going to be more expensive. The cost of learning gets more expensive the further you get along. So it's important to have those conversations and to think about it, hopefully sooner than later. All right, so how can we help these young people soar? We've learned the things that we need to do, but how do we make this possible? Keep the conversations happening. Whether they are young, in the middle, or older, perhaps fighting you to have a conversation, it's important to keep these conversations happening. Talk to them about how they're spending their money. Why are they choosing to spend it this way? Why do they want to go to this particular college? Have they thought about the cost of that college? Have they thought about trade school? Have they thought about community college? These are things that perhaps it might not be the cool thing to do, but it's an important conversation to have. Open a savings account early. For so many folks, they wait until kids are older, but your credit union is here to help you. We have the Roo Crew, Miss Risalina, Penny, and Cash are here to help young people start to learn about managing their money. We host after school snack time each Wednesday throughout the school year to help young people read books, have conversations, and to think about it. And we even go into communities and schools to talk about saving money. But having that account early is important for young people. Open a checking account as a teen. We offer student checking. We will also have special teen checking accounts coming out later this year, but we currently offer free checking for our students. We understand that as young people, they shouldn't get a monthly service fee. They can have free checking, and we want to help them learn about managing their money. We are regularly in schools talking about financial literacy and making sure they understand how to budget the money that they have and to spend it wisely, to make savings a priority, but to also spend it wisely when they are spending their money. Clicker's freezing. It's important to help them establish credit early. Having those conversations about whether or not you feel comfortable having them as an authorized user. Do you have a credit card you could help them to do this with? And then thinking about that time when it's time for them to get an auto loan. Perhaps they're not qualifying for it by their finances, but making them part of that process. And doing these things can make a huge impact. I have a coworker and friend who shared with me the story of their son. When they were in high school, they made them an authorized user on their credit card. It was a credit card that didn't have a huge limit. They would use it each month and they paid it off in full each month. Then they got their child a loan for their first car. Parents took care of that. But then when they were 18, they needed another car. And the parent qualified for the loan, but added their son as the co-borrower. That son was in the great habit of working and earning his money and saving and saving and saving. And because of what their parent did to help them establish credit early, at 22, they bought their first house. They saved enough for a down payment. And through the help of their parents, they had good credit to be able to qualify for that home loan. Now, I share that saying that may not be what every parent has done and every young person has been able to do, but to say that you can buy a house at 22, it's possible through hard work, from savings, spending wisely, and having some parents guide them and coach them along the way. I've been keeping an eye on the chat and the Q&A, and it looks pretty quiet. So I'm going to pause here and see if we have any questions. I know I've shared a lot of information tonight, but helping young people to be financially responsible is so important to me. I have seen over the years the effects for so many people to not have this information and to not be in a place that they are ready to be financially responsible. So we had a question come through. Should you put them on a credit card? So for many of us, the rules with credit cards have changed from when we were young, that students aren't getting credit cards at 18. Rules have changed that credit card companies can't advertise at them under 21. They need to have a job, and there's things that they have to qualify for. So having them as an authorized user can be a great place to start. But then when they are old enough to qualify for it, having something that is a low balance for them to use and to pay off regularly can be a great way to help them establish credit. The key thing is learning to balance and budget their money with that checking account, so they're only spending what they have, so that they don't get into that habit with a credit card of putting too much and having a huge balance that they're carrying, and then that affecting on their amounts owed portion of their credit score. Great question. Is a secure card best? Another great one. This is really going to depend on the individual person and kind of their credit situation. A secure card can be a great way to start, because that can be a savings secured card. So they're only spending they have saved, so they're guaranteed to be able to pay that. But the key is still making sure that they're keeping that balance low and trying to pay it off, because it's when we start carrying that balance on the credit card, we start seeing those negative effects to the credit score. Great question. Another question came through on our chat. Does obtaining a credit report affect your credit rating? So doing those hard pulls where you want to see your score look like inquiries. So you may see, like, if you're car shopping or like trying to apply for a credit card and different things, you'll see, as long as you do them during a particular period of time, you may see a dip in your credit score. But say you've applied for that credit card or that loan, and then you're paying it each month on time, then you're going to see the credit score start to go back up. But just going to like annualcreditreport.com to see your credit report, that's not going to hurt your credit. That's just going to save you from identity theft, hopefully. Ooh, another question came through. Is it safer giving teens a credit card instead of a debit card in case it's lost? This is really going to depend on your situation. If you have a checking account with the credit union and your credit cards, the nice thing with the debit card is you can go into digital banking and turn off your card if you've misplaced it. I have some folks that call in regularly and reach out to us because, like, oh, I had it. It may be in the pocket of my jeans, but it's at home. So they'll switch off their card and then look, and then be able to go, oh, nope, I found it. I don't need to reorder a new card. Losing a card, whether it's your credit card or your debit card, as long as you contact the card issuer right away, you're really going to protect yourself. So it's really just a matter of personal kind of feelings on that. Great questions, folks. I hope tonight's conversation has helped give you a little more confidence and some thoughts on what to do. But I'm a firm believer in that progression: savings, checking, then getting to the point of credit. And we all need to kind of take those baby steps to get there. Now, it looks like the question box and the chat is getting quiet. So hopefully we are all feeling confident and ready to let young people soar into adulthood. Thank you all so much for attending this evening. And if you have questions for us, do not hesitate to reach out. fined@henricofcu.org. And if you have things that you would love to see us cover, let us know that too. We want to make sure that the lessons that we are providing in our e-learning series are beneficial to you in filling that financial education need that you have. Thank you so much, everybody.